There's a $2.3 trillion debt bomb about to hit the banking industry, and the regional banks are directly in the blast zone. So if you thought the banking crisis was over, think again, because there's a debt bomb coming to the banking industry, and the regional banks are right in the blast zone. Yes, there are trillions and trillions and trillions of dollars on bank balance sheets, and the regional banks are in particular a major participant in this lending. It's estimated that the regional banks have $2.3 trillion on their balance sheet, and many of these loans are headed for problems. And of this enormous amount of debt that is outstanding on banks' balance sheets, approximately $52 billion of it is expected to mature within the next 24 months. And according to Bank of America, approximately 68% of these loans are on the balance sheet of regional banks. Now, this issue is very important because it's been well advertised with the failing of SVB Bank and also Signature Bank recently. A lot of people are focusing on the securities portfolios of these banks and how, with the rise in interest rates, particularly the long-dated securities that are held on these banks' balance sheets have gone down in value. What hasn't gotten as much emphasis and hasn't been talked about as much is the tremendous exposure that all banks, but particularly regional banks, have to commercial real estate. The reason why this is important is that this issue will affect bank liquidity, their balance sheets, and also their ability to lend, which is going to affect the economy and has a trickle-down effect all the way down through the economy. As you can see here, the regional banks are ranked third in terms of total exposure to commercial real estate loans, and they are ranked closely behind life insurance companies and, of course, agency financing like Freddie Mac and Fannie Mae. If you look at the regional bank exposure to commercial real estates as a percentage of total loans, you can see that many of them have a very high percentage of their total assets invested in commercial real estate mortgages. New York Community Bank being the highest. You can see number 3 there, Signature Bank, which is already collapsed, basically. And you can see many of the other companies that you've heard in the news, most notable First Republic Bank, which has 20% exposure. And many of these banks have already been put on Moody's list for potential downgrades. Some of these banks that are being looked at for almost immediate downgrades are First Republic Bank, Western Alliance Bancorp, Zions Bancorp, and Comerica, among others. Now, of course, all of these banking problems have occurred as a result of the Fed raising interest rates. And many of these real estate loans were put on at the peak of the market in a prolonged period where the Fed was keeping interest rates at zero and printing money like it was going out of style. And what's happened is the cap rates, or the capitalization rates, which determine the value of the property, have continued to go up and therefore have caused a decrease in the value of all of these properties across the board. The way this works is, as the cap rate goes up, if the income of the property stays the same, the value of the property goes down proportionally to the rise in the cap rates. So in this example, you see when the loan was originated, the cap rate was 4.5%. So the value of the property was $100 million because the NOI, or the net income of the property, was $4.5 million. You divide that $4.5 million, you can see on the right side, you divide that $4.5 million by the cap rate, which is 4.5%, and the value of the property would be $100 million. If the cap rate goes from 4.5 to 6.25, the value of the property goes from $100 million to $72 million, even if the net income of the property does not change. So you can see that even if you have a property where you're fully rented and the net income or NOI of the property has not changed and you haven't had any fundamental deterioration in the cash flow of the property, the value of the property has still gone down precipitously. Now, as the value of all these properties have gone down, if you have fixed rate long-term debt on your property and your loan is not maturing, it's really not a problem for you, because the fact that the value of your property went down really doesn't matter as long as you continue to pay the loan. But the situation is very different. If you had floating rate debt, which many properties do, it's gone up over 400 basis points in the last year. So your cash flow is going to be severely impacted because the cost of your debt has gone up, and in some cases they will not be able to continue to pay the debt even if their cash flow has not gone down precipitously. Now, in the case where you have long-term debt, you really don't have a problem as long as you don't have to refinance your debt. But if you do have to refinance your debt, like the $52 billion that are coming due in the next 24 months, in most cases, if the properties were fully leveraged, you're going to have a problem because the property has gone down so much in value that in order to refinance the debt and take out the debt that you already have on the property, you're going to have to put up more money. Some people will have the liquidity to put up more money, but many people won't, because in the real estate business, a lot of people syndicate their equity, and they have many investors that go into these properties, and those kind of limited partners hate capital calls. Now, when these loans default, in the case of a payment default, in other words, they can't afford to pay the debt anymore, or in the case of a maturity default, when the loan matures and they can't refinance it or don't want to refinance it because they have to put more money in, the borrowers in some cases will go through a default and a foreclosure. In other cases, they'll just give the keys back, in which case now the lender owns the property. This is a major problem for a lender because, number one, they don't want to own the property. And number two, this is going to be a tremendous hit to their capital ratios when they have to either write down the loan or when they have to write off the loan entirely in the case when they take over the property. Now, in addition to this being a massive potential problem for the banking sector, and obviously the shareholders of these banks, it has a very deleterious ripple effect in the economy. This happened in 08-09. Lenders were pulling back. It was very difficult for businesses and other real estate borrowers to get money. It impacts the economy. It slows down the economy, and it, in and of itself, could cause a very severe recession. In addition, when lenders pull back from the commercial real estate market as they are now, you see a lack of liquidity in the lending market, which also affects valuations of these properties. And when you see that combined with the expanding cap rates, you see what's called a negative death spiral in the commercial real estate business, which will inevitably exacerbate all of the issues I'm talking about and make the problem even worse. Now, one thing we don't know at this point is what is the Fed going to do if the economy starts to soften. Are they going to back off further rate increases and just sit tight, or are they going to actually begin in the future to reduce rates and have the rates come down again? We simply don't know what's going to happen in the future, but I can tell you right now, the commercial real estate market is in a bad situation. Values are declining, cash flows are declining, and this could have a very deleterious effect on not only the commercial real estate industry, but also the economy in general. So I encourage you to share your thoughts in the comments below. If you got value out of this, please subscribe and like. I'd love to have you on board for future videos. And at this point in time, I'd like to say, if you're interested in pursuing this concept further, I've got a great video here that talks specifically about the current banking crisis, and you can learn a little bit more about it if you're interested. So take a look at this one right now, and I'll see you on the next video.